What's up, guys? We're back. We're back. Welcome back. Did everyone, dude? HBT, nice to see you, brother. Where in the world are you right now, bro? Um, there we go. Okay. We're here. We got like 10, what, 10, 15 minutes, 13 minutes.
To cancel.
All right. See here. Everyone got their party hats. All right, let's see if we get some more peeps that come in, hang out with us here, guys. But I'm thinking bearish, guys. It's just a hunch, but I'm thinking bearish. It would be nice to I think it'd be cool to have a close down here towards the 4,000. If we break 4,000, even better. But what's up? What's up, guys? Does anyone have any guesses? So, let's play a game, dude. Just a little friendly game. Watch, where's my little chat? There we go. Puts at 410. See, that was my thing, dude. But like for us to get that reaction, right? To get the reaction all the way up to there and then come down would be pretty rough. Then we're kind of looking at that happening probably tomorrow. What do you think? I don't know why I'm so nervous for this announcement here. Like I usually pretty chill about it, but heart rate a little bit up this time for some reason. Where so All right, so not 830. Pop to 48 and drop to 400 is your guess. The open interest is at 407. So 407 may be the spot, dude. I like the idea though. So your guess is 400. Your guess is 400 and no change there. Was it? I don't know how to say your name. Mackinnon. So I guess what I'm saying is I would like to see the reaction towards 407. And I want to see how the VIX reacts. And we will go from there. So the 407 would bring us just above on the ES to these prior highs, Friday's highs pretty much, right? Yeah, Friday's a little bit above Friday, or not Friday. Why am I saying Friday? Yesterday, Tuesday's highs. Why am I thinking it's Monday, dude? Does anyone think maybe we get 50 basis points? Just call it a day, raise them and pause. Mm, where's don't think so. All right, 6 minutes. Um 50 basis points would halt the market, you think? I'd say we just hit the 50 and hold it until September. So was it 408 yesterday? So I have 406.53. 406.48 was the high yesterday. Well, that was the close. The high is a little bit above that. 408 is the one from what is this? So Wednesday, Tuesday. So this is Friday, yeah. Or wait, Wednesday, Tuesday, Monday, Friday. Yeah, Friday. Wait, Wednesday, Tuesday, Monday. Yeah, Friday, right? My headset is dying too. All right, so we're playing a little bit of game here. Anyone else that's in here, you guess the SPY closest to the SPY closing price for the day gets a gift card from me, whether you want to be Starbucks or somewhere else, Amazon, whatever. I'll hook you up. 410 even. You're like $1, Bob. Okay, cool. All right, we got David at 410. We got Mackinnon here at 400. Close under. Well, it's you can't say just under 407. 407 even. Okay, cool. Locked in here. Not here we go. Usually it's the second reaction. It's not the knee-jerk reaction. It's the second one that we're looking for. And I think we kind of know like what it's going to be 25 basis points. It's just kind of seeing what the actual reaction is what the reaction is. So 10 seconds. There we go. Oh, they kept them the same. Oh no, it's expected. So 25 basis points. Yep. So we got 25 here. So here's our first little reaction. Like I said, sometimes, most of the time, the knee-jerk reaction is not the way that we want to go. So we hit the 402. So 40, 50 here, almost on the ES. And but we are looking weaker here. There wasn't even like an attempt to pop as of yet here, guys. So there's still whole lot of volume though. There we go. Now pushing up here a little bit. And we're gonna get a big old fat nothing burger. So the VIX did push down here a little bit. Bulls are defending pretty good right here, guys. So not that we haven't made the pop up, but they're holding these levels here pretty good. Let's see if it's, oh, there we go. Bonds dropped. Is that a good or bad thing? But bonds dropping is more bullish, right? Still new to the whole bond thing. Up, down, up, down. Yeah, dude, this is like a Nintendo, old school Nintendo freaking cheat code, right? Up, down, left, right, left, right. Julio's guess is 400 even. All right. Here we go, dude. No, we're still just gonna go sideways the rest of the day, bro. Fed repeats ongoing rate increases will be appropriate. Inflation has eased somewhat, but remains elevated, is what they're saying. And determining the extent of future rate hikes, it will take into account cumulative tightening policy lags and economic and financial developments. The Fed has just announced more rate increases for the year. I would say that's not very bullish. Yeah, dude, I think we close honestly, man, I think we break 400 here within the hour. Did anyone take any trades? Anyone take any trades off the announcement here? I haven't quite yet, but I am liking this this pop up here for resistance. Still not much though. I want to see a little bit more weakness here. You're in Tesla calls? Tesla and Nvidia were pretty bullish all morning. I don't have any music on, man. My music. All right, now we're pushing here pretty aggressively upside. All right, so semis are pushing up here pretty strong. So AMD, NVIDIA pushing up nicely. The Qs are up here. The what is this? The VIX is going down. So some big volume right here into the resistance here in this area, guys. I would like to see this area break with a little bit more oomph instead of it acting as resistance. Where'd my chat go? There we go. What? Oh, there it is. Out of the Tesla, nice. DXY looking strong. So VIX is still tumbling down here, guys. Apple hit resistance and said no way so far. Same thing. So Tesla hit the upward resistance. Guess we're just trying to see if we get continuation here, because we know that this is the resistance area, right? So you guys think the bull party is over, or what the deal is over here? So Powell will be on the mic here at 2:30. Okay, I'm going to try some puts right here, guys. The same resistance that we had this morning in this area. Rejected again, less volume in this candle. I'll stop here at this high above 406. Yeah. Dude, I don't. AMD 83. I guess we're just waiting here. We'll wait another 14 minutes. Fed right now the 4.75% that we're at now with interest rates is the highest since September 2007. All right, Apple rejecting and coming down here, guys. Oof. Nice rejection here. We're looking good on my position here so far. This 4071 here on the ES has been level of interest here all day and in the past. So we need to break this, and then the 4060 here is the next important level to the downside. Still just riding this VWAP pretty much here. Come on, can we get moving here a little bit more quickly? Doesn't matter which direction, just pick a direction. Guess we're just waiting. This sucks, man. What's up, dude? Mr. Magic or Miss Magic, whatever way. Nice call on the puts. The puts, so far so good, dude. I'm still holding them. This 40, again, this 40, 70, 71 area is just kind of crazy. Apple and the Qs don't want to break down right here, dude. And for me, dude, unless something changes right now, like in the speech, it just absolutely seems a whole lot more bullish. This price action just screams very bearish to me. Like there's not enough. We went down without it pop up at first, and then we got up to this resistance and we just kind of rejected here, really, didn't give it a try here. And then it is holding though. It is holding this area very nicely. That's the only thing that I'll give to it for it to continue going up. Amazon had so much call buying today. Oops, I'm going the wrong way on my little feed. Remember dual mandate? I don't know. Does anyone know what dual mandate means? So this thing says Warren, Powell should pause rate hikes. Remember dual mandate. Does anyone know what that means? Because I don't. I see someone here in the chat pursuing the economic goals of maximum employment and price stability. Oh, did you just answer my question right now, dude? Who's S in my chat? Thank you, whoever S is. Is it sellers?
I'm not sure if it's Option King from the Discord.
Oh, what's up, brother?
Hey, what's up, man? How's the weather outside? Everything's frozen, man.
I know, dude. It's freaking
Crazy.
It's crazy because in New Mexico, this is pretty normal. And so out here, it shuts down the whole city.
Really? Yeah, man. It's crazy here. All the bridges and everything.
Well, it's different here too, because all the roads are made out of concrete. So it makes it to where everything freezes like that. And the other states like that, it's asphalt, so it's not so big of a deal. Maximum, so it's the goals of maximum employment and price stability. Chale, we'll do whatever we want. Come on, bring it on in here, SPY. Yes. Who the hell is Warren? Who are they talking about? Warren Buffett? Better reaction. This dude posted a picture of his dog just sleeping. Thank you, Giovanni. Thank you guys for the help there. The candles in these colors don't confuse you? No, they don't confuse me at all. I'm the one that made them change colors. So I would hope they don't confuse me because I made them change that way for a purpose. Now, there's times where it's because obviously these are just technical, right? They don't know that it's Fed day and that there was a Fed announcement or whatever. It's just price action that influences them, right? So there's times where signals for them are, I don't want to say contradicting, but it would not be the right, it would be not the right trigger or what have you, like in this, I mean, you could go out long right here, I guess, on the purple from here to here, but but to keep holding right here, it doesn't know that there's a catalyst that's moving the market right now. It's not organic price action, if that makes sense. Oh, absolutely, dude. So I'm a big advocate of liquidity support and resistance. I believe that, and you could ask all the guys that are in my chat, that I would challenge people to take all the indicators off of their chart and then just, outline where you think areas of interest and liquidity are, right? I'm also a big, I've talked about before where you don't necessarily, like, the time frames for your candles don't even necessarily matter as much. What matters is the areas of liquidity wherever the price action moves to, right? So in reality, you could probably come in, because we know if we're doing something like this here where I don't remember how to do the candles. Oh, right here, drawings, style. So we could probably come in here and just put in a line chart, right? Because we don't necessarily need candles. If we know that the liquidity is up in this area, right? Up in this area, then we don't necessarily need the candles to show us wicks and bodies and all that, right? We're just waiting for the price action to get to those levels and to see if it's going to overtake or reject those levels. So if you're able to actually recognize that, then that would be a major key for you. But yeah, absolutely, dude. I think that a lot, right? And a lot of our strategy is based off of liquidity of the option dealers as well, and where the option dealers are positioned here with the open interest and the gamma and things like that too. So, so yeah, I agree 100% with you. Where is there? It is. But yeah, I think the more simple you make your system, it's easier for you to stick to your system and trade it, right? If you're over analyzing 20 different points in order for you to take a trade, you'll never take a trade, you know what I mean? All right, so the meeting is starting here, guys. I don't know if someone wants to pull it up, or I'll pull it up here. Do you guys want me to turn on so you guys could hear it too? Oh, he hasn't come on yet. Okay, cool. Sorry, I was jamming out.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments.
All right, so Apple now showing that weakness coming down to
The
the
U.S. economy slowed significantly last year,
two.
with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies
Dude,
still
the
very
whole
high,
thing
and
about
wage growth
they're just
elevated.
trying to manage their risk. The TDM,
Job gains have been robust, with employment rising by an average of
you basically have to lie,
247,000
dude,
jobs
which is
per month.
not, I'm not
over the
telling you
last
to
3
lie.
months.
I'm not an advocate of that.
Although the pace of job gains
I
has
understand,
slowed over the course of the
wanting to
past
keep
year, and
integrity,
nominal wage growth
but
has shown some
on
signs
most
of easing,
places now,
the labor market
just-
continues to be out of
you have
balance.
to lie.
Labor
order to
demand
get the clearing.
substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total
Right, so
PCE
we're at
prices
40,
rose
50 here in the US,
5.0%.
40
Excluding the
here
volatile
on
food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive
But
sectors
to the
of the
downside, the
economy,
open interest that we
particularly
have
housing.
today, guys, for the
It will take time, however, for the full effects of
this
monetary
9,000
restraint to
right
be
here, the
realized,
403, 402,
especially
and
on
400
inflation.
is the big one with 38.
In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise
that would
interest
be the
rates
risk
by
there, Magic. So
25
that
basis
would,
points today,
and
continuing the step down from
and
last
just
year's
the,
rapid pace of
like
increases.
just the knowledge, right?
Shifting
So
to a
like,
slower pace will
you go and
better
you say,
allow
like,
the
if
committee
they
to
allowed
assess
you
the
to
economy's progress toward our
trade
goals
options and you
as
didn't
we
know the
determine the
knowledge of
extent
actually how to
future
do it and
increases that will be
everything,
required
and you try to sue
to
them,
attain a sufficiently restrictive stance.
then it just becomes a bigger.
We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris Rugaber, the Associated Press. Thank you
Oh,
for doing
now
this.
we got a little bit of a.
As you know,
Got a pop
financial
here.
conditions have loosened since the fall, with bond yields falling.
This price action is pretty rough,
which has
dude.
also
Just
brought down
sideways
mortgage
within this range
rates,
right here.
And the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course,
They're still
financial
showing
conditions have
resistance here in
tightened
this area,
very
though.
significantly over the past year.
The VIX is down pretty
I would say that our
hard.
focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been
So I stopped out here,
at a
guys.
historic low. Does this at all change your view of how much the unemployment rate would need to go
Order
up,
cancelled.
if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions. Go ahead.
Has your expectation for where the unemployment rate might go changed?
Okay, so what I'm looking for here now on my
We're going
screen
to
is
write
a
down
crossover, what we
new
call a crossover,
forecasts
so we
at the
pushed
March
up.
meeting, and
I like
we'll
it
see
to
at
come
that
and hold
time.
the PDC
I will
and
say
then
that it
continue
is
going up.
gratifying
The
to see
407 was the
disinflationary process
bigger resistance
now
here to
getting
the upside we
underway,
talked about on
and
the
we
open
continue to
interest
get
here,
strong
guys.
labor market
So now
data.
we basically have room
so-
here to get to that
But
410.
we'll update those forecasts in March.
Hi, Chair Powell. Neil
And
Axios.
on the ES here, we have room to
You
get
and
to
some of your colleagues have
the high
emphasized the
from
possibility
Friday.
that job openings could come down, and that would let some of the air out of the labor market without major job losses. We saw the opposite in the December jolts this morning. Job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings.
Yeah, the contract
number
prices
has
are
been
inflated
jolts, has
because of
been
the
quite volatile,
IV, the
recently.
expected moves
I
here.
did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to.
So the main target on the
to
ES, the
unemployed
upside
people
that we're
who are
looking for is
work.
4136.
So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
All right, so here we come. We're going to see if we retest this level, continue moving, like I was saying.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for
This
that
volume
was
is
between
super
5 and
nice here for this
5.25%.
breakout here, guys.
At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a
Didn't quite
sufficiently
get
restrictive
my
stance policy
crossover
to bring
play here,
inflation
so
back down to 2%.
still flat.
We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say
The VIX is like
we still think there's work
way
to do
down,
there.
1853
We haven't
right
made
now.
a decision on exactly
Apple
where
is
that
at
will be.
resistance
I think
where it
we're
opened
going to
today.
be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said.
In
December, we
hindsight,
can
I
certainly
did
do
get,
that.
I mean,
At
I
the same
got a
time,
little
if data
bit
come in the other direction, then
greedy
we'll make
here.
data-dependent decisions.
I hit
in the
a
coming
really
meetings, of
nice
course.
rejection right here, and we got all the way down to
How are you viewing the kind of
402.45
balance of risk
for my
between those
entry
three
at 405, and I didn't
the
cover or
likelihood
take
of
anything.
maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in. And now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that.
So we definitely broke
I do
Friday's
think that
highs here.
in
or
this
what is
situation,
it? Yeah,
where we
Friday's
have still
highs.
the highest inflation in 40 years.
Again,
The job
4036
not
is our
fully done.
target to the
As I
upside here on
mentioned,
the
started to
ES.
mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in
We hit
core
4100
services
pretty much on the nose
ex
by
housing is
1
still
penny
running at 4% on a
here
6
on
and
the
12
SPX
month
and
basis. So
pulling
there's
back just a
nothing
little bit.
happening there. In the other two sectors representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation
A
down.
little bit of
And how do
resistance here
how
on
do
the
we get
Qs
that
and
done?
also on the SPX as
There
well.
are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all
Dude,
the
almost
reasons
at
that you said
410.
prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. we can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a
So
big sector.
411
This is what we thought would happen
50 or
since the very
so would
beginning,
be
and now
the.
here it is.
So we pretty
actually
much gap
happening,
filled
and
that
for
we
the
filled
reasons
this
we
gap
thought.
right here with
It's
this
supply
previous
chains,
high
it's shortages,
at
and it's
this level.
demand
So
revolving
almost there at
back towards
410.
services. So this is a good thing. This is a good thing.
410 or
But that's
481.
around a quarter of the PCE price
And then
index,
we have this
core
gap
PCE
to
price index.
about
So the second
412
sector
where the higher
is
volume is
housing
at.
services.
So
And that's driven by very different things.
a lot of
And
open interest
we-
though at that
As I
410
mentioned, with
level,
housing
so-
services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different
So
kinds
Apple
of
pushing up
services.
here really
Not all
nicely
of them are
still.
the same.
Microsoft
And,
is
we have a sense of what's going on in each
going
of those
really
different,
good.
subsections. Probably the biggest part of it, probably 60% of that is
Yeah, 9 cents off
research
of
would show
410.
sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's
So right
not that we're
now,
not- we're
those
either optimistic
407
or
calls that
pessimistic.
were in
We're just
here,
telling
these
you that
guys,
we
all the
don't see
35,000, they're going to
inflation
have to
moving
start
down yet in that large
buying
sector.
too.
I think we will fairly soon,
And
but
it's
we don't
going
see it
to
yet. Until we
make us
do,
move a little bit more
I
strongly
think we,
because
you
they
know,
have
we see
to
ourselves we
cover
gotta be
their
honest
loss
with
on these
ourselves. We
contracts
see
that were
ourselves as
sold.
having
So,
perhaps more
and
persistent,
then we have
we'll say, more
21,000 right
persistent
here at the
inflation in that
410.
sector,
So
which
if
will
we
take
start breaking
longer to get
410,
down.
then we
And we're
we
just going
go
to have to
way more
we have to
strong
complete the job. I mean,
here
that's
if we're
what
able
here
to
for.
continue going.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more
Four
rate
hundred
hikes
998.
to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that though. We don't know that. So I
41.36.
think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start
All
to
right,
drive
so the
describe all
Qs are
details,
right
but
under
that was the sense of the
300 right
discussion, was
now.
really talking quite a
Thus,
bit about the path
things
forward.
are a little bit extended, but it would be absolutely awesome if it's able to break and continue going.
Hi,
Ross,
Chair Powell. I wanted
this
to ask
this has
about
been our
the
target.
debt
Our
ceiling.
resistance here was
Given that
410.
we've now hit up against it, I was wondering if the U.S. goes past the
And not,
X
and I'm not
will
saying
the
just
Fed
today. I'm
do
saying
whatever
over
the
the
Treasury
macro for like
directs as it relates to
for a
making
while.
payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we, say your question again?
Will the Fed do what
There we go,
Treasury
over
directs
410
as it
now.
relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have
All
been
right, so
clear.
things kind of
would it
taking
be
a breather
possible
here at
to
these
take the
resistances.
meeting off, for example, and then resume? Could you, rather than just doing at every meeting?
Like I said, if we're able to break
go
and
a
stay
little bit
over
more
this with how
slowly,
late
take
we
some
are in the
naps
day here,
between
guys, we
those?
will see monster
I think
squeeze.
This is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Oh, bull market.
Steve
So
Reisman,
I don't.
CNBC.
Someone
Mr.
had
Chairman,
posted where like we
the
need to
SEP
cross
has the,
in order for us to be officially back in the bull
PCE
market. I don't
inflation
remember
rate
the
in
price though.
2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've
Ooh,
considered the
Beto
idea
broke
whether or
out.
not,
So crypto is
your
also breaking
understanding
out
of
right
the
now,
inflation
guys.
dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something
Come
around
on,
zero.
market. You have one more pushing you.
a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. You know, let's say inflation does come down much faster than we expect, which is possible. As I mentioned, you know, obviously our policy is
absolutely,
we would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector.
So here's our crossover play on this R1
in the
here,
economy,
guys.
sensitive to the labor
I'm going to go
market
ahead and
anyway.
try
But some of the other sectors
a
are
very
not.
small position
And
since
for
we're so
example,
extended here
financial
on calls.
services is a big sector. That's really not driven by labor markets, wages. So that's why I
So I'm
said
risking
there are a
right
number of things
below
that will
here,
affect.
this
Take
408.
restaurants, right? So clearly labor is important for restaurants, but so are food prices. And, you know, transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. You know, it's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be.
Apple pushing up here again, guys. Microsoft as well, trying to break out of this little flag.
More slowing than
And
we expect, than I expect, to get inflation down to 2%.
Qs are trying
but
to
I don't. That's not my base case. My
get
base
over
case
300
is
right here.
that the economy can return to 2% inflation without a really significant downturn. Or
This is the top of the hour, so power hour officially.
That's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward.
So the volume is dying up in this level here, guys.
The recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is
Tesla's
is
trying to
improving a
push
bit.
here to break high of day
And that
at
will matter for us
180.
potentially. The
Nvidia
labor
is
market
also, dude,
remains
I haven't seen
very, very
Nvidia is
strong.
moving crazy up
And
here.
that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base
Come
case
on,
is
Q's.
that there will be positive
Break
growth.
the
this year.
300.
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good, good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the
Big push
the
right
labor
here on
market
the
coming
Qs,
back into
guys.
better
Or
balance
that
and have
300.
substantially more evidence?
So I
New highs.
don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level.
130 right here.
Still
We have
at
about
a level
6
that's
more
way
points
well above where they
on
were
the
before
ES to target.
before the pandemic. So I
Nvidia
don't want to put a number on it in terms of
Tesla.
months, but
So tech
as
actually
the
leading us here pretty nicely,
accumulated
guys.
evidence
I
comes
wish
in,
Apple would push a
it's
little
going to
bit
be
more
reflected
strongly,
in our assessment
but
of
it
the
is what
outlook,
it is.
and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not market participants have a very different job, and it's a fine job. It's a great job. I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Right. So like I said, over this 410 right here, we get
Thank you, Fed Chairman.
we get pretty
Taking the questions.
squeezy here
So
because
you've talked about we had
those
solid
option dealers have to start
job
buying
growth,
futures and shares in order to offset
we had
losses in the
solid job
contract.
growth,
So
slight falling in the
and we
increase in
don't have
consumer
much
spending.
time for it.
It
So
seems so far it's
the
been
closer we
relatively
get to the
mild,
end of the day
for
and
the
we're
economy
above
to go to
410,
from a 9.1%
the more we're likely
CPI
we're
inflation
to continue
6.5%
moving
CPI inflation.
aggressively up.
Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down. And Congress did what it did, and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation.
We're almost going to break 411.
That's great.
But like I said, it's 412 is the target right here on the SPY, but we're pretty much at target on the ES.
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth some
some profit
softening
right
in
here,
labor market
guys.
conditions and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy.
I just wish I would have caught it from down
Of
here,
course,
dude. It would have
other
been
people have
freaking
forecasts
awesome.
with inflation coming down much faster. That's a different thing. You know, if that happens, if inflation comes down much faster, you know, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Thank you, Chair Powell. Simon Rinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that.
That's
again,
pretty much the meat of the move here, guys. We hit all our targets. We're above 300 on the Qs.
Generally, those forecasts
4036 right here on the ES. We hit 4040 right to I have a resistance area right here drawn out.
Recession,
and like I said, 412 or so up here, 41188 is where the higher volume node is at. So pretty much met the target there. Honestly, if you're interested in taking puts here into going into next week, I think that's
we'll just have to see.
a good idea in my opinion.
We have a different view, it's a different forecast really. Given our outlook, I don't see us cutting rates this year if we get if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy saying, of course.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, we understand, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, you know, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that, you know, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's
opening order, Phil,
or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. I don't see that yet. But the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue. And once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. Is consumers and businesses essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock
I
belief.
think now we hit these
in one way
targets
or
up here,
another.
guys.
It has to be. We think it's important.
We may get
And,
under
in
410
this
here
case,
by the close.
I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Order cancelled.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or
If
up
we
and
get
down,
to
but came in roughly
the
the
half
same
hour
place.
mark and we have not gotten below
It's important
410,
that the markets do
then
reflect the tightening that
we'll
we're
get
putting in
another
place.
push.
As we've
But
discussed a
it looks
couple
like
times
they're
here, there's a
walking it down here.
difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Order filled.
So all out of my positions here, guys. I think I'm going to call it an afternoon and a day. I hope you guys were able to make a little bit. Didn't get to talk too much about strategy or anything here today, guys, with the Fed stuff. We'll get more into that in the coming days. We'll be here bright and early tomorrow on YouTube. So if you guys want to come and hang out here on YouTube tomorrow, I will definitely be here. I start about 8:45 or so market time. And there's that, what we're talking about is where they'll try to get it back under this 410. So once we've seen this resistance and we hit those targets, so this would have been a nice little puts right here to get back under this 410, where that open interest is stacked up at right here, this 21,000. So other than that though here, guys, very nice. Appreciate you guys coming in and hanging out. Like I said, we'll be here bright and early. Send me any DMs if you have any questions or anything. We'll see you guys tomorrow, right?